The stock market can seem like a complicated machine with its fast-paced environment and constant fluctuations, but it's simpler than you think. At its core, the stock market is a place where people come together to buy and sell ownership in companies. Think of it as a giant marketplace where you can buy and sell pieces of companies, just like you would buy goods from different vendors in a market. These pieces are called stocks. Each stock represents a small portion of ownership. Companies sell stocks when they need money to grow their business. They might want to develop new products, expand into new markets, or hire more employees. They get this money from investors like you. By selling shares of their company, they raise the capital needed to fund their growth. When you buy stock, you're essentially becoming a part owner of that company. This means you have a stake in its successes as well as their failures. You're putting your money into their hands, trusting them to use it wisely and grow. It's a partnership where both parties benefit. If the company does well, the value of your stock goes up, and you make money. This is the reward for your investment and trust in the company. However, it's important to remember that investing in stocks also comes with risks. If the company doesn't perform well, the value of your stock can go down. That's why it's important to do your research and understand the companies before investing. Diversifying your investments can also help manage risk. Education and staying informed are key to making smart investment decisions. The more you know, the better equipped you'll be to navigate the stock market. The stock market works much like an auction. It's a dynamic environment where buyers and sellers come together to trade stocks. Just like in a traditional auction, participants place bids and offers, hoping to strike a deal that benefits them. Buyers place a bid on the price they're willing to pay for a stock, which represents the maximum amount they are prepared to spend. These bids are carefully calculated based on various factors, including market trends, company performance, and economic indicators. Sellers, on the other hand, set ask prices for what they're willing to sell for. The ask price is the minimum amount a seller is willing to accept for their stock. This price is influenced by their own valuation of the stock and their need for liquidity. When a bid and an ask price match, a trade occurs. This means that both the buyer and the seller have agreed on a price, and the transaction is executed. This process ensures that stocks are traded at fair market value. The price of a stock fluctuates throughout the day based on supply and demand. These fluctuations are a reflection of the market's perception of the stock's value at any given moment. Various factors such as news, earnings reports, and economic data can all impact stock prices. If more people want to buy than sell, then the price goes up. This is because the increased demand drives up the value of the stock, making it more expensive for new buyers to enter the market. If more people want to sell than buy, the price will go down. The excess supply of the stock reduces its value, making it cheaper for new buyers to purchase. This constant ebb and flow of buying and selling is what makes the stock market so dynamic and exciting. So how do you get started in the stock market? The first step is to open a brokerage account. This is like a bank account for your investments. There are many online brokerages that make it easy to get started. Once you have an account, you need to start your research. Don't just buy any stock you hear about on social media, the news, or from friends. Look for companies that are financially sound, have a good track record, and operate in industries you understand. The next step to take is diversification. This will be the key to successful investing. Don't put all of your money into just one or two stocks. Instead, spread your investments across different companies, industries, and asset classes. Diversification helps reduce your risk. If one stock in your portfolio performs poorly, the others can cushion the blow. What are some benefits you can expect from investing in the stock market? Over the long term, stocks have historically outperformed other asset classes like bonds and savings accounts. This means your money has the potential to grow much faster in the stock market. However, it's important to remember that investing in stocks is a long-term game. Don't expect to get rich quick. Be patient, stay invested, and let your money grow over time. While the stock market offers great potential for growth, it's essential to understand the risks involved. Investing in stocks can be a roller coaster ride, with prices fluctuating based on market conditions, economic indicators, and even global events. It's important to be prepared for these ups and downs and to have a strategy in place to manage them. The value of stocks can be volatile at times, and you could lose some or even all of your investment. This is why diversification is key to mitigating this risk. By spreading your investments across different sectors and asset classes, you can protect yourself from significant losses. To manage risk, start by investing only what you can afford to lose. This means setting aside money for your essential expenses and emergencies before you even think about investing. Your investment capital should be money that, if lost, won't impact your day-to-day living. Don't invest money you need for essential expenses. This includes your rent or mortgage, utilities, groceries, and other necessary bills. By ensuring that your basic needs are covered, you can invest with clarity of mind and less stress. Secondly, diversify your portfolio to reduce the impact of any single stock's performance. A well-diversified portfolio might include a mix of stocks, bonds, mutual funds, and other investment vehicles. This way, if one investment performs poorly, others may perform well, balancing out your overall returns. Finally, stay informed about market trends and economic conditions that could affect your investments. Regularly review your portfolio and make adjustments as needed. Keeping up with financial news and consulting with a financial advisor can help you make informed decisions and protect your investments in the long run. If you found this helpful, be sure to like, subscribe, and click that bell icon, and check out my other videos like this one here.